Hello everyone, this is Stuart. Hope you all had a nice weekend. On this week's update, we'll discuss progress on the US-China trade front, momentum for Google's TPU chips, advances in quantum computing, and the big week ahead in earnings. In a dramatic change in tone from 2 weeks ago, the US and China appear to be making progress toward a more positive trade arrangement. Treasury Secretary Scott Bessent confirmed that negotiators reached a substantial framework in talks he categorized as constructive to avert the 100% tariff on Chinese imports that was set to take effect November 1st, saying that the tariff threat is effectively off the table for now. The framework includes several key components. First, China will delay its rare earth export licensing regime by 1 year. Second, China will resume large-scale purchases of U.S. soybeans and agricultural products. Third, the U.S. may relax some of its technology export controls. And finally, both sides agreed on a broad outline covering TikTok's ownership structure and fentanyl cooperation. President Trump and President Xi are expected to meet later this week in South Korea during the APEC summit to formalize the framework and announce next step working groups on trade, tech, and national security. Markets are taking this development as a sign of de-escalation, giving a lift to risk assets to start the week. To be sure, however, the underlying tensions between the two countries, particularly around technology and national security, is unlikely to fully resolve. Shifting gears, Alphabet's position in AI infrastructure strengthened further last week with the announcement of Anthropic's agreement with Google Cloud to service its Claude models. The deal grants Anthropic access to up to 1 million of Google's tensor processing units, the company's custom AI chips, representing a purchase commitment estimated in the high tens of billions of dollars and scaling to roughly 1 gigawatt of compute capacity by 2026. For Alphabet, this validates the commercial competitiveness of its in-house TPUs, which were once primarily used to power internal models such as Gemini and Search. The Anthropic contract positions Google as the first hyperscaler to successfully monetize proprietary silicon at scale, providing an alternative to NVIDIA's near monopoly in AI training infrastructure. Strategically, it marks a transition from dependence on third-party GPUs toward vertical integration across the AI stack, hardware models, data center, and cloud services. We also note that Anthropic has a major partnership with Amazon to host its models and is working with the firm on developing customized chips. The deal with Google, we think, does not indicate anything negative for Amazon, but rather highlights the demand for more compute capacity and strategic sense in diversifying partners. For investors, this deal underscores that control of compute capacity, not just access to it, has become a defining variable in AI economics, one in which Alphabet has inherent advantages. Sticking with Alphabet, the firm also made headlines in quantum computing research last week. CEO Sundar Pichai announced that Google's quantum Willow chip achieved the first independently verified quantum advantage, executing a complex physics simulation more than 13,000 times faster than the best classical supercomputer. What distinguishes this experiment is verifiability. Results were reproduced through cross-checking algorithms, addressing the credibility gap that has long limited quantum claims. While still in early stages, this milestone signals a promising future for advances in material science, drug discovery, energy optimization, all areas where quantum methods can model atomic scale interactions beyond classical computing limits. While much enthusiasm has surrounded startup quantum stocks of late, we think it will be difficult for startup firms to compete with the resources that companies like Alphabet, Microsoft, and IBM can dedicate to this cutting-edge research. It's a big week for earnings when it comes to the S&P 500. Later this week, we'll get results from Microsoft, Alphabet, Meta, Amazon, and Apple, together representing about 25% of the S&P's market cap and key holdings for many of our portfolios. Recall that as earnings go, so typically goes the market, at least over the long term. And if early results are any indication, the outlook remains constructive. For the companies that have reported so far this quarter, 80% have beaten estimates, the highest percentage in over 4 years. Key themes investors will watch are impacts from trade uncertainty, signs of consumer and business strength, and the pace of AI investment in infrastructure. On the subject of AI capital expenditures, the numbers are getting almost unbelievably larger. CapEx from Alphabet, Amazon, Microsoft, and Meta alone is expected to hit roughly $325 billion this year, jumping to about $500 billion by the end of the decade. For now, demand for compute and power continues to exceed supply, and the market is rewarding this investment. As we previously discussed, the open questions are around the durability and payback. How long can this level of spending persist before depreciation and power costs begin to compress margins? And how tightly will incremental revenue track incremental CapEx? Will investors value tech firms with the same multiples if they permanently shift from capital light to capital heavy business models who consume more of their cash flows for infrastructure investment? While we remain constructive about the prospects for US large cap tech firms, the future performance could hinge on which firms can convert massive infrastructure spending into sustained revenue earnings and cash flow growth. Thank you for your time. Please let us know if there's anything you'd like to discuss in more detail. Have a great week.